Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit, and my name is Alex Matthew. This show gets you actionable insight on everything mutual fund related. And we speak about everything under the sun related to mutual funds, but sometimes we get you the people that manage your money, because it's important to understand how they think, how they're constructing portfolios, and what is the approach that they're taking. And today in studio, I've got with me Trideep Bhattacharya, the CIO Equities at Edelweiss AMC. Trideep, thanks so much for taking the time.
Thank you for inviting me.
It's an interesting time that we are at. We've just seen the Fed rate cut. This is something that the global market was looking forward to, and we're currently in the midst of what seems to be a rally post that. In the Indian equity markets, momentum seems to be flagging just a tad bit, just shy of 26,000. Did you think a year back that we'd be talking about 26,000 on the Nifty 50?
Good opening line. I would say, we don't think in terms of numbers, but if you ask me whether about a year back we were constructive, yes, we were certainly constructive on Indian equities, not just for this year, but I would argue that over the next 3 to 5 years, and even probably as long as the policy continuity stands to happen, Indian markets are in good shape with regards to earnings, and hence as a source of wealth creation for investors. In this context, the rate cut that we saw is probably a step in the right direction for those economies where growth has been fledgling over a period of time.
Okay, but let's talk about the most recent update. Of course, we've seen certain moves by the Chinese central bank. That was this morning, where they're trying to make money available to banks. There was a little bit of a rally in metal stocks today on account of that. How much of a factor do you think China is going to play in everything that goes forward? And there's also geopolitics, which is the joker in the pack. There seems to be more on that front every day. Oil prices have been benign. How many moving parts from the global scenario are you watching, Trideep?
Trust me, there are quite a few.
Yeah.
I think the importance of China is in certain sectors more than others. These certain sectors usually tend to be commodities-led, or for that matter, as you're saying, metals, mining, and chemicals. These are certain sectors which are very directly linked with demand scenario in China. But I think if I look at the most important thing that I watch globally is global companies' earnings. And I think if you look at global companies' earnings, companies have been talking about weakness in China and have been cutting guidances driven by weakness coming out from there. So this recent move in China is probably a response to that. Now, the other calibrated stance that one needs to understand when it comes to China is, while growth will rebound, the pace of growth ain't going back to what we saw in 2000s or earlier. And I think that is what companies need to adjust in terms of their own expectations coming out of China and calibrate growth accordingly. So a whole bunch of data points, but most importantly from my companies, from a portfolio standpoint, we watch out global companies' earnings, particularly the industry leaders in the individual segments.
Okay, fair point. Let's turn the conversation now to India. We've laid the global context. From the perspective of India, we've seen more conversations, and the data as well supporting that. More fund managers are holding on to cash. Now, I'm curious about this because there was a recent article that talked about Warren Buffett himself, the great man, holding on to cash and a considerable amount of it, and having missed the opportunity to gain in what has been a raging bull market, not just in India, but globally. Is that a dangerous approach? What is your own approach to keeping cash?
I must admit, I have a stance. There is a way we manage portfolios. It may not be the best way, but it's a sensible way for sure. And in my opinion, a sensible way is to stay invested. Because ultimately, from a medium-term standpoint, we are constructive in markets. So holding cash and trying to time the market has been a mug's game for centuries together. It continues to remain the same. Time in the market is sort of very important, and hence we stay invested. But majority of myself and my time, my team's time is spent on where we want to put the money to work. On a relative basis, where are the alpha opportunities that are there in the market? Which are those areas where earnings are likely to be more resilient than that of others, and they stand up better than that of other sectors, so to speak. If we did the same, then irrespective of whether markets go up or down, we remain one of the best ways to create wealth for investors in absolute terms as well as in relative terms versus the benchmark that we sort of compete against.
So how much cash on an ongoing basis are you comfortable holding?
So we hold usually less than 5% of our fund in the form of cash, on an ongoing basis.
Okay.
And basically the cash that we hold is mostly transient in nature. Either we are getting in or out of certain stocks, or for that matter, we are trying to manage the liquidity from a fund perspective, not trying to time the market.
Okay, then how do you manage the stretch? Some would say stretched valuations on the higher end, because the natural expectation then would be that you rotate into sectors that are relatively under.
Right.
Can you put that into context for us? What are you seeing right now, and how are you rotating?
Great question. So I would provide two cuts of the same, one by market cap and second by sectors.
Sure.
So if you split the market into two parts by market cap, one is the large cap and the second is mid and small caps. I would say that, or I would argue, that the large cap valuations are at par with their 10-year average.
Okay.
So there is no valuation fraud or excess in there. On the mid of small cap, the valuations are 20 to 45% higher than 10-year average. But that's only half the story. The other half of the story is that the earnings growth of mid and small caps are close to double that you find in large caps. So you can't completely ignore the mid and small caps either. So the best approach from this point of view I would recommend is basically having a right mix between large, mid and small in the portfolio, and allocate basis where the price value equation looks the best.
Okay.
So that's one way to slice the market. Hence our favorite portfolios in the current markets are flexi-cap funds, or for that matter, multi-cap funds. The other way to slice and dice the market is by the sectors. So on a relative basis, whichever sectors earnings are likely to be more resilient than others will most likely hold up better. And to position the portfolios in those areas on a bottom-up basis is what we do on a day-on-day basis. So in that context, for instance, since we talked about rate cuts, incrementally we know that the sectors that benefit from rate cuts are non-banking financial companies, they are real estate, and they are also IT services over a period of time. So over the last 3 to 6 months, these are the areas that we have allocated more capital to in the context of our portfolios.
Okay.
So two cuts of the same.
That's interesting perspective. I want to talk a little bit more about certain other sectors, and
Sure.
delve a little deeper into the financial space, because it's been said that the banking stocks have incredible promise but are underrepresented right now. People are not yet rotating into them. Earnings is not something that they're comfortable. The large private sector banks, some in particular, there are certain other issues in terms of deposit growth. What is your opinion on the sector?
So financials, Alex, today is a reasonably heterogeneous sector.
Okay.
So there are banks, and within banks there are private sector banks, public sector banks.
Yes.
There are insurance companies.
Yes.
There are capital markets companies, and then there are NBFCs, the two non-banking financial services companies. If I were to lay the land in front of you in this way, sub-aggregating the financial sector, we would be most positive at the moment on NBFCs. This is where we think over the next 6, 12, 18 months, as rate cuts take their shape, would stand to benefit with regards to their financials and hopefully their share prices.
The large ones or the small ones, though?
Well, depends on what segments they are in, rather than large or small is the way I would put
Okay.
it. With regards to banks, I must admit we have been taking profits on the PSU banks because we thought that easy money has been made over the last couple of years. The valuation catch-up has happened, and now they have to showcase better earnings growth, so to speak. On a relative basis, we are overweight private sector banks, but overall, I would say that the best times of banks are what we have right now. They have the best of credit growth, they have the least of asset quality worries, and the best of margins. As the business cycle turns going forward, some of these parameters may not be as good as what it has been in the past. But for areas like NBFCs, insurance, capital markets, we think, are probably better positioned on a going forward basis over the 6 to 12 months within financials. So a more nuanced view, but well, that's how that's one third of the market.
And that's how you think about constructing your portfolio. So that's
right.
Interesting insight to have. I'm curious about what you think, and we've spoken about a few sectors, but I'm curious what you think about whether there is a need to review certain tried and tested valuation methodologies from the perspective of what we've seen over the last 2 or 3 years in India, particularly over the last year and a half, because every dip has been very aggressively bought and liquidity has been absolutely flush. And so from that perspective, what you were saying at the start, waiting on the sidelines may not be the best approach. Having said that, on the upside as well, you would have to, you said that you booked out of PSU banks, but there might be a worry that says that that rally is not going anywhere.
So I think, so in order to understand how much rally is enough, we did a bit of a study. We looked at other countries which have gone through similar transitions in the past. This is going to be a verbose answer, so bear with me with a month or two. We looked at Japan, we looked at Korea, we looked at Taiwan. During 1950s to 1990s, the transition period as they went from an emerging market to a developed market, and what it meant from an equity market standpoint. And what we came back with is during periods when they had strong policy continuity, when they favored certain sectors than that of others, as long as they created global competitive industries, the GDP per capita went multifold, and along with the stock markets over a period of 2 or 3 decades. So rather than getting into numbers, for example, Japan went almost like 30 to 40x over that time frame, 20 to 30 years. So in that context, as long as the policy continuity stands to happen in India, which seems to be the case, as long as there are certain sectors where we have competitive advantage and they do well over a long period of time, I think the story is just about starting rather than kind of coming to an end.
So from that perspective, what I get from that is that you're not too worried about valuations, you're worried about the underlying story, which is not going anywhere.
Right.
That's the...
Which is, and want to be focused in those areas where the earnings are going somewhere, which is hopefully up, rather than kind of stagnating. Okay. So as long as we are invested in those sectors where earnings are kind of growing at a reasonable clip and valuations are reasonable, that's the sweet spot which we want to operate.
Interesting, because a lot of investors, Trideep, a lot of your investors as well, who have come in over the last 2 or 3 years might have been completely spoilt by the kind of returns that you and your peers have managed to deliver. The market as a whole has managed to deliver. And so from that perspective, I get it. You are saying that you believe in the fundamental growth story of India. But having said that, how do you benchmark your return expectations? And this coming from a fund manager would be very important. In your opinion, how should an investor benchmark their return expectations?
The true calibration of returns from stock markets are basically earnings growth. And if you look at last 20 years, India's earnings growth has been somewhere between 15 to 20%. And I think as long as an investor sticks along for a 5 to 10 years, is a reasonably long period of time, which is what is needed for investing in equities, I think an expectation in sync with the earnings growth that we have seen is something that one should come by. Now, sometimes the investor's entry point might be at a high point or low point. The longer the period of time, the importance of entry point kind of subsides, and the earnings growth takes over. So on a systematic basis, I can't put numbers as to what expectations are, but I think the earnings growth is the true calibration of what returns that people should expect from equities over a decade or so.
Absolutely. I have enjoyed this conversation, Trideep. Thank you so much for joining me in the studio. Pleasure having you as always.
Pleasure is mine.
Now, we have to take this conversation forward, but let's take an aspect of what we were talking to Trideep about, which is the holding of cash. We've got Vishal Dhawan, founder and chief executive officer of Plan Ahead Wealth Advisors, joining in. And Vishal, hopefully you've managed to catch a portion of the conversation that I had with Trideep. What do you make of the higher amount of cash that fund managers are holding?
So I think it's a reflection on two different things that could be there. One is that for a set of managers who are holding excess cash, it could be just driven by of monies flowing at this particular point in time. So inflows coming in need time to get deployed. And therefore, if you have very strong inflows, the deployment can end up taking a little bit of time. And we're clearly seeing fairly strong flows coming in from retail investors. The second element could be deliberate, where cash is being used as a protection tool because of the way valuations may be. And therefore, there aren't enough opportunities available to deploy that cash. And I think it really depends from manager to manager in terms of how they run their own portfolios, in terms of how they're looking at cash as a part of their strategy.
But to take this forward then, I was looking at the numbers and we've played some of that on the screen. While we talk about it, maybe we can do so again. But there are a few fund managers and fund houses that have stated in the past that they are comfortable going very high on the amount of cash that they hold if the valuation methodology or the valuation picture demands that. One of them is Parag Parikh Flexi Cap Fund, which is currently at about 13%. You have the Motilal Oswal Mid Cap Fund, which is at what, cash and cash equivalents of over 20%. The question is, if somebody is uncomfortable with that idea, saying that, look, I'm giving a fund manager money so that they can deploy it into the equity markets, then what should their approach be?
So I think there are, again, two things to look at very carefully here. So one is the returns that you make off a fund may not only come through the cash positions or the excess or lack of it. They could be coming through the sectors that you're buying into, through the stock selection that you're doing. So there are multiple things coming together to ultimately define what kind of a return an investor makes. And what it could therefore mean is that just using cash as the basis to decide on whether it's a good idea to be in a fund or not, or a scheme or not, is probably not a great place to be in. The second thing we need to keep in mind is that, again, at certain points, like we've historically seen, cash has a very valuable role to play in protecting downside. And what we've seen historically is that, when downsides happen, which are steep, and because they haven't happened for the last 2 or 3 years, there is a recency bias clearly visible, saying that, every correction will be short and it will be followed by a higher level on the index rather than a lower level. But if you do believe that mean reversion does end up happening, then you also want to be sure that when situations arise where you want to be able to deploy money, you have that available to take advantage of so that you can buy into opportunities that may be available at a stock level or sometimes even at a sector level, where you might find that there is bad news around a sector that comes in and you want to buy multiple names within the same sector.
It's a fair point. In your experience, having looked at some of these schemes over the years, has that panned out? And of course, in the near term, because you are holding a certain amount of cash, you are sacrificing on near-term returns that some of your peers might have. But over the long term, one would assume that that results in both downside protection and the ability to deploy at a lower level whenever that situation emerges. So in your experience, have there been instances where this has panned out?
So it has. I mean, I think just because you spoke of a particular scheme, if you go back and look at cash levels in that particular scheme in the pre-COVID era, just before COVID happened, you'd notice that their cash positions were roughly about 2 times what a lot of other funds had at the same time. So obviously there was a drag on performance leading into COVID. Of course, no one expected COVID to happen, just like no one expects a market correction to happen right now. But typically what happened is, as that correction happened, you did find that there were some benefits that came from holding that cash. Now, what is difficult to establish is whether the benefits came from the cash that they held or because the stocks that they held for the rest of the positions and the sectors that they had were actually what contributed to the return rather than the cash. And I think that's where it gets very hard for investors to actually take out one particular factor like cash and say that something is appropriate or inappropriate just because of that one driver. Because the returns in a fund are going to come from different constituents. It's not going to come only from the cash position.
Yeah, that's a fair point. And some strategies require the holding of that cash, and some others, like Trideep was mentioning, his philosophy is to not hold cash and to deploy it and to rotate the portfolio as he sees fit. It's interesting, Vishal, we keep getting queries on our show, and there are several that have come through. I've sent some to you, and let's take some of them. We've got Sridinath, who's asked the first question. He's investing through SIPs for 3 months now. His portfolio currently consists of 75% in equity, 25% in debt and gold funds. He's seen gains of about 2%. He's not specified which his schemes are, so I'm not really sure whether he's asking about the overarching strategy in terms of asset allocation, but he's asking if this is feasible to continue.
So I think this is a great question for everyone. I think, there's been a lot of conversation, obviously, about the SIP flows, right? And in general, markets always go through 3 phases, and it doesn't matter whether it's equity or not, even gold, even debt. It goes through 3 phases. One is where you actually get a lot of returns in sort of short periods of time. The second is when you just see a long period of a flatness, or let's say a time correction. And third is when prices actually come down. Now, depending on where you are in this cycle, your return outcomes will be very different. And the whole idea about an SIP is to get away from this prediction of cycles saying, am I going to be in this upward moving cycle, flat cycle, downward moving cycle, etc. And just focus on saying, I'm going to invest in a disciplined manner because I'm 25 and I want to put this money away for a long period of time. The fact that my returns are 2% actually does not really mean anything, just like if the returns were -2 would not mean anything. In fact, what you want to do as a SIP investor is hope that a lot of your asset prices come down so that you can keep on buying at lower and lower prices rather than worrying about it. So I would say don't focus on a 3-month basis on an SIP return. In fact, if you have to wish for something, wish that market's correct so that you can put away and get more units for the same value of money.
That's
and
a fair
you'll
point.
see the benefits come out over a long period of time.
That's a fair point, Vishal. And in fact, I read a study recently that said that it does not matter whether you start an SIP at the peak of a cycle or the trough. You will more or less get similar returns. And in fact, deploying early is always better. Rahul Panjiar has got the next question. He started investing in the Nifty 50 index fund, then shifted to the Nifty Next 50, and he's now also thinking about the Nifty 500 Momentum 50 index fund. Which is the best for the next 40 years? Now, it's a very, very long time horizon, Rahul. He's 20 years old and he's thinking about it from the perspective of his retirement, which is a good thought. Vishal, what do you say about this?
So I would say that the starting point of this decision has to be that, it cannot be an either or decision, which is what one is seeking here. It needs to be that you need to get a market cap weighted index like the Nifty 50, or if you want participation of a slightly larger range, maybe you can get a Nifty 100 index fund. If you want, all the top 100 large cap stocks represented in the index. But typically you would want one of those, either the Nifty 50 or the Nifty 100, becoming one part of your portfolio. The second part, which is linked to the momentum, is something that investors need to be very mindful of. That momentum does tend to be a great strategy and a great factor when markets are heading upwards, because there is a tendency for momentum as a strategy to outperform a lot of other factors. But in much the same way, in a different cycle, you do end up finding that it also falls more. And the question, therefore, is that even though you have a 40-year investment horizon, are you willing enough to see your momentum fund underperform significantly when markets correct? Because that's what tends to happen very often. And still stay invested. In fact, maybe again buy more, because that may be the time to take advantage of upward momentum as and when it comes back. And therefore, I would say that a larger allocation would have to go to a broad Nifty 50 or a Nifty 100 fund, while you could take a tactical allocation if you have the risk appetite to the momentum index, maybe anywhere between 10 to 20%, but you need to have that risk appetite clearly to be able to handle it.
Fair point, and that's an important point to make as well. We've got a couple of minutes more, just about. Saurabh has asked the next question, Vishal, so a quick answer. 4,500 rupees per month is the amount that he can invest. He's 33 years old and he's looking for a few suggestions that he can look at. Now, I must state that this is not going to be a recommendation. This is simply what Vishal looks at and finds interesting. Vishal?
So I think one of the missing links here is obviously, how long he wants to invest for, which is very hard to figure out from this question. But let's assume that he's just because of his age, he's looking to put this away for retirement, for example. I would say that he needs to look at essentially three things that he can do together with this 4,500 per month. One is buy into an Nifty 50 index fund to give him broad market exposure to the Indian markets. Similarly, look at an S&P 500 index fund to get exposure to the US markets and be geographically diversified to manage his risk. And the third bit is bring in an active fund like a flexi cap fund, where the fund manager can make decisions on moving across market caps, across sectors, and across stocks, basis what he or she believes is appropriate. So I think that those three put together should be good for Saurabh if he's thinking about a long term.
Flexi cap that you like? One flexi cap that you like?
So the Parag Parikh fund, even though we were just discussing it from a cash perspective, has an excellent track record, though there is near-term underperformance that is clearly crept in.
Fair point. Vishal, thanks so much as always for taking the time. Pleasure speaking with you.
Thank you so much.
And that brings us to the end of this edition of the Mutual Fund Show. The number that you saw on your screen, that's where you send questions to us. Lots more coming up over the course of the day. And this is NDTV Profit.